When planning to buy your first home, it's important to consider all available options to maximise your savings. While personal savings and government grants are often discussed, another valuable tool is the First Home Super Saver Scheme. The First Home Super Saver Scheme allows you to use your superannuation to save for a deposit on your first home. It works by cycling your savings through your superannuation, reducing your tax burden, and as a result, growing your deposit faster. In this video, we'll explore the First Home Super Saver Scheme in depth to help you understand what it is and how it works. The First Home Super Saver Scheme enables first-time home buyers to make voluntary contributions to their superannuation and later withdraw those contributions along with any associated earnings to put towards a deposit on your first home. The scheme takes advantage of the tax benefit of superannuation to help you save more effectively. There are three main components of the scheme: the eligibility criteria, the contribution limits, and the withdrawal process. Let's examine each of these in detail. To be eligible for the First Home Super Saver Scheme, you must meet the following criteria: be over the age of 18 to release the funds, never have owned a property in Australia, including investment properties, intend to live in the property you purchase for at least 6 months of the first 12 months after purchase, and you can only make one withdrawal under this scheme. If you're buying a property with someone who doesn't meet this criteria, maybe they've purchased a property in the past, it's okay, you can still use the scheme. Under the First Home Buyer Super Saver Scheme, you can contribute up to $15,000 per financial year with a total maximum contribution of $50,000. Contributions can be made from your pre-tax income as concessional contributions or after-tax income as non-concessional contributions. Concessional contributions are commonly used as they provide the greatest tax advantage. These contributions are taxed at the low rate of 15% within your super fund compared with your marginal tax rate, which can be as high as 47% when the Medicare levy is included. You can make voluntary concessional contributions via way of salary sacrifice or personal deductible contributions. Non-concessional contributions, on the other hand, aren't taxed when added to the fund, but also don't allow you to reduce your personal income tax. It's essential to note that contributions made to the First Home Super Saver Scheme are counted towards your regular superannuation contributions caps. Exceeding these caps may result in additional tax liabilities. To access your savings under this scheme, you must apply to the Australian Taxation Office for a determination and release request. The ATO will calculate the maximum amount you can withdraw, which is a combination of your eligible contributions and the associated earnings. Once approved, these funds can be used towards your first home. The released amount will include your eligible super contributions, less a 15% tax on concessional contributions, plus your associated earnings. Earnings are calculated based on the 90-day bank bill rate plus 3%. For voluntary concessional contributions, the withdrawn funds are taxable with a 30% tax offset. You must include the assessable amount in your tax return. The ATO will withhold an appropriate amount of tax and deposit the net balance into your nominated bank account. Non-concessional contributions are released tax-free, as no tax benefit was gained when contributing the funds. Before utilising the First Home Super Saver Scheme, here are a few important points that you need to consider. 1. Lodging your determination. You must obtain a determination before signing a contract to purchase a property. This can be done through your MyGov account linked to the ATO. 2. Requesting release. After lodging your determination, you can request a release of funds. This can be done either before signing a contract or within 14 days of the signing. It may take up to 20 business days to receive the funds. 3. Timeframe for purchase. Once the funds are released, you have 12 months to buy a property. If you don't purchase an eligible property within this timeframe, a 12-month extension may be granted by the ATO. After 24 months, the funds must either be recontributed into your superannuation or kept with a flat First Home Super Saver Scheme tax rate of 20% being applied. 4. Notifying the ATO of purchase. Once you've signed a contract to buy or construct a home, you must notify the ATO within 28 days via your MyGov. 5. Division 293 tax. If your total income plus concessional superannuation contributions exceed $250,000 in a financial year, an additional 15% tax may apply to some or all of your concessional contributions, bringing the total contribution tax up to 30%. 6. higher future marginal tax rate, if your marginal tax rate is higher when you withdraw the funds than when you contributed the funds, the tax saving you initially enjoyed might be reduced or even offset by the higher tax on withdrawal. 7. Assumed earnings. The earnings on the money contributed to super aren't market linked. Instead, an assumed return is applied, which provides more certainty around your withdrawal. However, withdrawing during a market downturn could impact your long-term retirement savings. And 8. Losing access if no property is purchased. If you don't buy an eligible property, the money will remain in your superannuation until you meet a condition of release, usually when you've met preservation age, which is currently age 60, and have retired from the workforce. The First Home Super Saver Scheme can be very tax effective to build a deposit for the purchase of your first home. We also like it because it brings discipline to your savings. You can't be tempted to spend your deposit because it's trapped inside your super. Typically, this is a strategy that we'll employ in phase 1 of wealth creation, where a principal residence purchase is determined appropriate as part of building your financial foundation. If you think the First Home Buyer Super Saver Scheme is an appropriate strategy for you, we strongly recommend you speak with your financial advisor. They can help assess the appropriateness for your particular situation. Please note, the information contained here is general in nature only and does not take into consideration your objectives, financial situation or needs. As legislation is constantly changing, the accuracy of this information is only current as at the time of recording. Before relying on the information, you should check to see if the content is still relevant.